Okay, guys, welcome to tonight's class. So this class is day two of the Deferred Tax free masterclass. So today we're going to just continue on where we left off yesterday. But for those who are new, I am Faiz Khan, and I run EduHon's, which provides online courses for aspiring chartered accountants to help them pass their exams confidently. And we focus on third year and CTA students. And our ultimate purpose is to be a place of hope, a place of optimism. And by doing so, we aim to unlock your true potential. Many of us have potential that is hidden, that is locked away. So what we try to do is to unlock that potential, your true potential, and we do that by basically simplifying complex content and by giving you an approach to tackle any exam question. So that is basically EduHon's in a nutshell. And yeah, and who I am Faiz. Okay, so what I want to just do a quick recap of what we did yesterday because of the problems we kind of had yesterday when we with my Zoom and stuff like that. So I'm going to do a quick recap and then we're going to continue today, right? So before we get started, it's supposed to be a 2-day masterclass, but because I need to do a recap and I still need to finish off content that I didn't finish off yesterday, we're going to have to do a third day as well. So today we'll finish all the theory, and then in the third class, we're going to do a question paper. Now, we're not going to do, so remember, I do an hour to 90 minutes. I don't do 100-mark question paper. I take like a 20, 30-mark question, and then I spend 90 minutes on it. That is all. That is kind of the advice I give most of my students, is take a question paper that is between 20 and 30 marks and spend 90 minutes on it while you are in the learning phase. Obviously, in an exam, a 30-mark question you can't do in 90 minutes. You need to do it much quicker. But in the learning phase, I recommend is rather take your time so that you make sure you analyze different aspects of a question. And then as you move on, you speed up the process so that you are able to handle a question within the available time. Because remember, you want to focus on one thing at a time. You don't want to do two things. So the two things you generally have to focus on is to learn the underlying principles and how to apply, how to tackle a question. And the second thing is to do it within the time frame. So for most of us, especially people like me, I can't do two things at the same time. So I focus on one thing. Now, without knowing the content, time is useless. So therefore, I start off with learning the content. I take my own time with it. So a 30 marker in 90 minutes or 20 marker in 90 minutes is very long, but the process we go through is thorough, so that when you move on into more questions, you should be able to speed up the process and finish within time. Also, the 90-minute process also allows you to cover multiple questions within the same question. So I never recommend doing 100 questions. I recommend limiting it to 5 questions, but doing those 5 questions thorough. You don't need to run through your whole cut letter of every single topic. So some topics have 10 questions. You just need to do 3 to 5, and then you should be good. If you are still not getting it after 5 questions, then doing a 6th, a 7th, or 8th question is not going to help you. It is there's something fundamentally that needs to be rectified. So I always advocate 3 to 5, and you should be good. Obviously, if you are able to do 10 questions, then that's great. But never do 10 questions at the expense of quality. Rather do less questions, but you accommodate for the quality of a question paper. I'm not going to go into detail as to what is a quality. What do I think is a quality process? I will share that. I'll share that with you guys another day. I want to get into this deferred tax question. So remember yesterday, so where I was going with this, so the third class is going to be in the Saturday slots. Okay, so so every Saturday, or not every single Saturday, but almost every Saturday, I'm going to run a free class on between 11 and 12:30 max. So I aim for 11 till 12, but sometimes it will go over up until 12:30, so 12:30 later. So if you want to join, just keep 11 till 12:30 open, but the aim is to be 11 till 12. So this Saturday, we're going to finish up deferred tax, and we're going to do the question on deferred tax on Saturday. I will share with all of you, I'll send out an email with the Zoom link on Thursday with the question we're going to be doing. Okay, so I'll send a Zoom link, and then you will be able to join on Saturday. Yeah, so that is that. And then every other Saturday we will do, so next week, following Saturday, so every Saturday, or almost every Saturday, we'll do a free class, 11 till 12, 11 till 12:30. Okay. The topics, there's still something I need to think about which topics we're going to be covering. But in those Zoom classes, we're not really going to do theory. We're going to do more like a 10-minute recap on theory, and then we'll tackle some like a 15 to 20 mark question, because I take very long with the question. So a question will be limited to a 20 mark question. Okay, so that is basically what we'll be covering. I will ask you guys what topics, and then we'll do a vote. You're not going to vote. You will tell me which topics, and I will do a tally up of which topic is coming through them as most common, and that is what we will tackle. Okay, so to get into this class, to recap what we did yesterday. So remember, we did a big picture overview of regarding deferred tax. We went through the income statement, and we showed that sales, cost of sales, other income, other expenses, and ultimately profit before tax is determined using accounting rules and principles. Then we have income taxes, and without deferred tax, income taxes is basically is calculated or determined using the Income Tax Act. So if you say profit before tax minus income taxes, we get profit after tax. So that means the profit after tax number is a combination of tax laws and accounting principles. But we don't want that. We want profit after tax to be an accounting number. So therefore, to get profit after tax to be an accounting number, we somewhat need to rectify. We somewhat need to rectify income taxes. So when we rectify income taxes, we kind of rectify it in inverted commas using deferred tax. Okay, so that was basically the big picture. Okay, let me just switch over to my screen. So just do not confuse people. Where is this now? Okay, so this is basically what we went through. Okay, so that is basically a high level. So to rectify, we basically say current tax plus deferred tax to get to an income tax number that represents an accounting number. That concept will come through nicely when we do a tax rate recon, but I will explain that when we get there. Okay. Then I said before, we're going to go through some of the important definitions, and these were the important definitions that we went through. Okay, so these were the important definitions that we went through. Now, with the important definitions, before we went into the definitions, we spoke about what is an asset and what is a liability. And we weren't focus wasn't so much on the definition and recognition, but rather on what does an asset actually mean when it's sitting on the balance sheet? What does a liability actually mean when it's sitting on the balance sheet? So we said, when you see an asset on the balance sheet, when you see PPE, and if you pick up a set of financial statements and you see property, plant, and equipment, or you see trade receivables, or you see inventory, if you see that on the balance sheet and you see the amount, basically what the company is telling you is that the company will generate economic benefits of those amounts. So if PPE is sitting at R1,000,000, the company is telling you in future, we expect to generate economic benefits from this asset to an amount of R1,000,000, at least R1,000,000. Similarly, when you see inventory on the balance sheet of R500,000, then basically the company is saying, we expect in future to generate an economic benefit of at least R500,000 from this asset. If the asset can't generate that amount, the asset would need to have been impaired. Okay, so just take note of that. So when you look at the balance sheet and you see all the assets, you have a look at the asset and they'll tell you, okay, this asset you expect to receive a certain amount. Similarly, with a liability, when you see a liability on the balance sheet, it basically means that the company is telling you in some way or another, they expect an outflow of economic benefits in the future. They have an obligation to make a payment or to give away some other asset or so forth in future. So they expect an outflow of economic benefits. Okay, so remember, that is basically what it means when you see an asset and when you see a liability on the balance sheet. Then we went through and we said on a high level, or on a very, very simplistic definition of deferred tax is got to do with future tax consequences. So deferred tax is got to do with future tax consequences. Remember, income taxes is made up of two things, current tax and deferred tax. So current tax deals with current tax. Deferred tax deals with future tax. Now, future tax or future tax consequences is an accounting concept. Deferred tax is an accounting concept. Current tax, that is a tax authority concept. Okay, so that is for our purposes in South Africa, our tax authority is SARS, and the way we determine tax is in terms of the tax acts. So in this case, it would be the Income Tax Act. Okay, so remember there's different tax acts: income tax, VAT, I don't know what else. Estate duty, transfer pricing, customs, all of those type of stuff. Okay, so just take note of that. So that was one important definition. Then we said it is important to know the definition of the tax, of what is a tax base. Okay, so remember, the carrying amount refers to the carrying amount from an accounting perspective. So someone asked, is it always cost minus accumulated depreciation? And the answer is not really. Okay, so when we speak about carrying amount from an accounting point of view, you have to look at the nature of the asset. Okay, you have to look at the nature of the asset. When we say the nature of an asset, it means the type of an asset. So for example, you can have a building. Okay, so what is the nature of the building? Well, it depends. The building could either be PPE, it could either be inventory, it could either be investment property. It all depends on what is the intention of management. So if the building is used to earn rental income, if the building is used to earn capital appreciation, then it would be investment property. So what would be the carrying amount over there? It would be whatever IAS 40 investment property dictates to us. If the building is sold in the ordinary course of business, if a building is sold in the normal course of business, meaning it is the business of the company to buy and sell buildings, then the building will be inventory. So the carrying amount of a building would then be in terms of IAS 2 inventories. If the building is owner occupied, if a building is used in the production of income and owner occupied, then it will meet the definition of PPE. So then it would be cost minus accumulated depreciation. Okay, so that is what PPE dictates. So remember, when you talk about the carrying amount from an accounting perspective, then it all depends on what does it depend on now? I forgot. It all depends on what is the nature of the asset. What type of an asset is it? Okay, so you apply the different accounting standards. Now the tax base the carrying amount from SARS's point of view, that is known as the tax base. Okay, so the tax base for an asset, that is the amount that will be deductible for tax purposes. The word will means means in the future. I just put the word in future over here to emphasize future. Okay, but the word but when we say will mean it must still happen. Okay, so will and in the future is the same thing. I'm putting in future over here just to emphasize it. So the tax base of an asset, that is the amount that will be deductible for tax purposes. Then we have a liability. For a liability, we have a normal definition, if I can put it that way, and we also have an income received in advance definition. So with a normal definition, well, the word normal doesn't sound right in my head. So let's just change this to general. Remember, the accounting standard doesn't call it general. Okay, so I'm calling it the general one. Okay, so so for normal liability, it is the carrying amount. When we use the term carrying amount, we're referring to the accounting carrying amount minus, this over here represents minus any amount that will be deductible for tax purposes. Okay, so just to give you a quick example, we're going to cover it. I'm going to cover the exact same example when we do deductible temporary differences. But basically, to give you an example, many companies would have a bonus. Okay, so they give their staff a bonus. Okay, so at the end of the year, they would generally recognize a bonus, that they maybe approved a bonus or something of that nature. So at the end of the year, they just assume at the end of the financial year, they approved a bonus, but the bonus will only be paid in 2 months' time. Okay, so the 2 months' time falls into the next financial year. Okay, so at the year end, they already have a present obligation to make payments, okay, because they said they approved the bonus. So now in the accounting records, we would say debit bonus expense, profit and loss, credit bonus accrual. So we have raised a liability for a bonus accrual. Now the question is, what is the tax base of the liability? Well, we will have to, we will look at what is the definition of a tax base for a liability. So the definition would be carrying amount minus any amount that will be deductible for tax purposes. So let's assume the bonus that was approved was 1 million rand. So the liability is sitting at 1 million rand. To get to the tax base of the liability, we would say carrying amount 1 million rand minus any amount that will be deductible for tax purposes. The word will mean that will be deductible in future for tax purposes. Now, in order to know what will be deductible in future for tax purposes, we need to know how would tax treat a bonus. Now, remember, I cannot remember the section in the Income Tax Act. It just kind of slipped my mind. I cannot remember the section. There's a specific section that specifically talks about bonus and leave and so forth, that say that leave pay, bonus pay, and so forth those items, SARS only grants a deduction once it is actually paid. So therefore, SARS will give us the deduction, but SARS will only deduct it in 2 months' time. So therefore, therefore, the tax base for this liability would be carrying amount 1 million rand minus any amount that will be deductible for tax purposes. So what will be deductible for tax purposes is 1 million rand. So therefore, the tax base for this liability will be 0. Okay, so that is basically how to think through it. I'm gonna move on quickly because we're gonna cover that exact example just now. So then the second definition is a liability, income received in advance. Okay, so for income received in advance, the definition is carrying amount minus any amount that will not be taxable for tax purposes. Okay, so any amount that will not be taxable for tax purposes. So let's just give an example. Okay, let me just see what example I have here. Okay, so let's just assume you have a you earned in you provide some kind of a service, right? So let's say at the end of the financial year, you strike a deal with some customer that you need to provide some services in the new financial year. Okay, so you need to going to provide let's say you have is rental income. Let's just assume it is rental income, and they're going to lease your property next year. Okay, so you're gonna have your lease. They're leasing a building from you, and they're paying a rental income. But they're only going to start using or leasing the building in the new financial year. But they made a payment in this financial year. So you received money, but you did not yet provide the service. Okay, so what would the accounting journal entries look like? So the accounting journal entry would look as something like this. Let's just assume it is 10,000 Rand. The accounting journal entry would look at something like this. You received money in the current financial year. So you received cash. Cash is known, we call that account bank. Bank is an asset. Because you received money, bank is increasing. Bank is an asset increases on the debit side. Okay, so you received 10,000 Rand. So I'm going to say debit bank 10,000 Rand. What did you receive this money for? You receive this money in respect of a building that you, in respect of rental income for a building that you are leasing. Now the question is, can you recognize rental income? And the answer is no, you can't, because the rent, you're only going to provide the service next year. So therefore you can't have a rent income. So what do we call it? You have an obligation to either return the person's money, or you have an obligation to provide them with this with the property so that they can use it. So therefore you have a liability. So because the liability is increasing, a liability increases on the credit side. So we're going to have income received in advance, okay, rental income received in advance, credit 10,000 Rand. So here we have a liability. The carrying amount at year end would be 10,000 Rand. So now we know what is the carrying amount. We need to determine the tax base. Remember, what is a tax base? Carrying amount less any amount that will not be taxable for tax purposes. What now we need to ask ourselves, how would SARS, how would the Income Tax Act treat this transaction? So remember, from an income tax point of view, if you apply the gross income definition, we're making money. So remember the income tax definition, the gross income definition, it's a long definition, but part of the definition says the earlier of receipt or accrual, okay? So part of the definition refers to receipt or accrual. So you received money. So therefore, when did you receive the money? You received the money in the current financial year. So SARS is still also going to do the following. SARS is also going to say, we acknowledge you received money, 10,000 Rand. But what is SARS going to do? SARS is not going to recognize a liability because the gross income definition says receipt or accrual. It will fall into gross income if there is a receipt or an accrual. You received the money. So therefore, SARS is going to say it's going to go into gross income. So therefore, SARS is taxing you for this amount this year. So next year, when you actually provide the service, SARS is not going to tax you because they have already taxed you. So therefore, the tax base for this liability would be carrying amount, 10,000 Rand, minus any amount that will not be taxable for tax purposes. So next year, accounting is going to recognize the revenue. Next year, accounting is going to say, debit income received in advance because we don't owe anybody anything. We provided a service and we now earned the rental income. They're going to say credit rental income. So next year, in our income statement, we're going to have rental income. But from SARS's point of view, they're not going to tax this rental income. Why? They have already taxed it in the current financial year. So therefore, carrying amount, 10,000 Rand, minus any amount that will not be taxable for tax purposes. So next year, that 10,000 Rand will not be taxable for tax purposes. So it'll be 10,000 minus 10,000. So therefore, the tax base at the end of the current financial year is 0. So it's very important to understand why an amount is an amount. I know many of us, we included, we kind of saw patterns. We see a typical example and we know what the tax base is going to be. But the question is, can we explain why the tax base is what it is? So this is explaining why the tax base is what it is. So the tax base for this income received in advance would be 0 because it's carrying amount, 10,000 Rand, minus any amount that will not be taxable. So what will not be taxable next year? SARS is not going to tax the 10,000 Rand because they have already taxed it in the current year. Okay, so that is the definition of a tax base. That is a definition of these two. Remember, there's more to this definition. This definition is much longer than what I shared over here, and there's some important parts I left out, but I'm not going to go into those details. I just gave the most basic aspect of it. Okay. The next definitions is knowing what is a taxable temporary difference and what is a deductible temporary difference. Why this is important is the recognition of a deferred tax asset and the recognition of a deferred tax liability. So the accounting standard IAS 12 talks about the recognition criteria on when they talk about the recognition regarding a deferred tax asset or deferred tax liability, the accounting standard says that you will recognize a deferred tax asset when you have a deductible temporary difference. You will recognize a deferred tax liability when you have a taxable temporary difference. So that is why, in order to recognize a deferred tax liability, there must be a taxable temporary difference. In order to recognize a deferred tax asset, there must be a deductible temporary difference. So therefore, we need to know what is a taxable temporary difference, and we need to know what is a deductible temporary difference. Now remember, a taxable temporary difference will result in taxable amounts when in determining tax profit or loss in future periods. Why it's important, it's all about future periods because deferred tax deals with future tax consequences. Okay, so remember, it will result in taxable amounts when you calculate tax profit, not accounting profit. When you calculate tax profit. So either when you are recovering an asset or when you are settling a liability. So once again, recovering an asset talks to this definition over here, talks to that definition over there. An asset is, in simple terms, is a glorified expense. Why do we call it a glorified expense? When something is when an item is outright an expense, we expense it immediately. Okay, but when something is an asset, it first goes to the balance sheet, and only after certain events, then it goes through the income statement. So, for example, inventory. Inventory is a glorified expense. Inventory is an expense waiting to happen. So what do we mean? If for inventory, it first goes to the balance sheet. It first goes to the statement of financial position as an asset, telling users that this is the future benefit we're going to receive from this item. Then when inventory is sold, when that event happens, when the inventory is sold, what happens to inventory? It gets removed from the balance sheet, and it goes to the income statement as cost of sales. So an asset is basically an expense waiting to happen. It's a glorified expense. Similarly, with an item of PPE, let's say machinery or vehicle or equipment, it goes to the balance sheet, okay, sitting as an asset. And when we have an amount over there, we are telling the users, this is the future benefit we expect from the asset. So what happens is that as we use the asset, then we depreciate it. Where does depreciation go to? Depreciation goes to the income statement as a depreciation expense. And the asset is reduced through accumulated depreciation. So as you can see, every asset will eventually hit the income statement after certain events takes place. So that is what is meant by recovering the asset. So you can recover an asset in one of two ways, either through selling the asset or through using the asset. Okay, so as you recover the asset, if that results in taxable amounts when calculating tax profit, you will have a taxable temporary difference. Similarly, when recovering or settling a liability, if that results in a deductible amount when calculating a tax profit, you will have a deductible temporary difference. So a deductible temporary difference, when you have a deductible temporary difference, you will recognize an asset. When you have a taxable temporary difference, you will recognize, when you have a deductible temporary difference, you will recognize a deferred tax asset. When you have a taxable temporary difference, you will recognize a deferred tax liability. Remember, when you have a taxable temporary difference, you recognize a deferred tax liability without thinking. When you have a deductible temporary difference, you may recognize a deferred tax asset, but remember, in order to recognize a deferred tax asset, certain things needs to be in place. It must be probable that you will have taxable profit in the future. If it is not probable that you will have taxable profit in the future, then you won't be allowed to recognize a deferred tax asset. Because remember, in order to recognize an asset, it must meet the recognition criteria. The recognition criteria says there must be an amount that is measurable, and that amount that is measurable, which is the future economic benefits, those future economic benefits must be probable that you will receive it. Okay, so just be aware of that. So then we did some examples over here. Okay, so I'm just going to recap this taxable temporary difference example, and then we're going to go on to doing a deductible temporary difference example. But before I move on, is there any questions at this point? Any questions at this point? Okay, I'm just looking in the chat. I don't know if you can hear. You can see some people can speak now. I never connected my external mic. I'm just using the mic of the laptop to avoid any problems. I'm just checking the chat. I see some questions in the chat. I'm going to respond now. Agatha, there's definitely examples like that. I just can't think of something, but as you do the question, I will think of something. Okay. There can be, but it's highly technical. I mean, yes, it's very like that. It's not like general, if I can put it that. It's not like general. So what you must understand, they're not going to try to remember what you must get in, what you must be, what you need to be satisfied with is that examiners are not trying to trick you, right? All they are doing is trying to prepare you for your final exam and ultimately for the ITC exam or for psychers exams. And psycher is not trying to trick you. Psycher is trying to prepare you for the real world, okay? So why I'm telling you that is that they're not going to make up stuff. Okay. Sometimes they will make up stuff to test the principle, but in most cases, they're not going to make up stuff. They want to keep it as real as possible because they want you to be ready for the working world. So to be ready for the working world, they make it as real as possible. When I say as real as possible, they're going to set up examples in a manner that for accounting that actually happens in the real world, for tax that actually happens in the real world. Now and then they will throw exceptional examples. So there could be something what you're making mention here, Agatha, but I can't think off the top of my head. So it's highly unlikely, but it's far and few between. Okay, so don't stress too much about that. But if you do, just apply the basic principles. If I come across one, I'll try to remember and let you know. Okay. Any other questions? Any other questions? Let me just check. Yeah, we will share the recordings afterwards. Okay, so let's continue. So now we're going to go on to this question. Okay. A taxable, I'm going to run through this very quickly because we did with this yesterday. Because I want to go on to the deductible temporary differences and then I want to finish off on some of the other important principles when it comes to deferred tax. Okay. So a company has a machine at a carrying amount of 1,000 Rand. The tax base is 800 Rand. Determine the deferred tax consequences. Okay. So remember, I'm giving you the carrying amount, I'm giving you the tax base. In another question, you must be able to calculate both, or they can give you different types of information, and you must be able to get to those stuff, okay? I'm keeping it as simple as possible, because I'm assuming you'll be able to calculate tax base and be able to calculate carrying amount. So I gave the example over here. So for me, so what I do over here, I tell the examiner what is it that they have an asset or liability, and then I'll tell them for me a debit is positive and a credit is negative. Okay. Similarly over here, I will tell them if it's a negative answer, it is a debit. If it's a positive answer, it is a credit. So debit over here means an asset. Credit over here means an asset. Once again, debit means an asset. Credit means an asset. But when it's a debit for deferred tax, it means it is a deductible temporary difference. When it is a credit for deferred tax, meaning a deferred tax liability, then it is a taxable temporary difference. Okay, so that is why this is a positive number, which means as a deferred tax liability, which means is a taxable temporary difference. Now that is just using the formula over here, but we want to know why it is a taxable temporary difference. Okay, so we made mention we have a deferred tax asset of PPE machine, 1,000 Rand. We have a tax base of 800 Rand. So there is a temporary difference of 200 Rand. So 200 Rand times 28% will give us a deferred tax of 56 Rand. We need to see whether we need to determine whether this is a deferred tax liability or a deferred tax asset. So I'm saying it is a liability because it's a taxable temporary difference. Why is it a taxable temporary difference? In order for it to be a taxable temporary difference, it must meet the taxable temporary difference definition. Will result in taxable amounts when calculating tax profit in future periods when recovering an asset. Okay. So what I told you is you must write this out when you do deferred tax. This is not part of your workings. This is not part of your answer or anything of this nature. This is part of your learning. But as you do this, let's say 2-3 times with 2-3 different questions or in the same question, then you must slowly not write it out, but think through it in your head. And it will take some time. But as you get, so if you first write it out, once you're comfortable with the thought process of writing it out, then you stop writing it and you just think through it. And as you do that regularly and consistently, then automatically your brain will think in that manner. So I'm not just making up stuff. This is like based on neuroscience, right? How your brain works. So remember, you have two parts. Well, there's maybe more parts of the brain, but basically you have two parts. You have the conscious and the subconscious. The subconscious mind deals with, do most of the work. So breathing, blinking, so many stuff. What your subconscious mind is doing automatically. If we had to use our conscious mind to do what we are doing, our brains would crash. Okay, so the subconscious mind deals with basically, if I remember correctly, reading definitely more, at least 90%, but I think actually 95% of what our body is doing. The subconscious mind is responsible for 95% of it. The other 5% or the other 10% is done by the conscious mind. So the more, but something enters the subconscious mind via the conscious mind. So therefore you need to consciously do what you need to do so that it actually ends up into your subconscious mind. And remember, long-term thinking comes from the subconscious mind. So as you practice, you want to write this out, think through it. And once you are comfortable writing it out, then you just want to think through it. Once you are comfortable thinking through it all the time, your brain is going to be so used to it that when you come across a deferred tax question, the brain is going to pick up that as a deferred tax question, and the subconscious mind will send forward the thinking mechanism. Okay, but if you are just studying quickly, if you are doing quick memorization, it is short-term memory. It doesn't go in. So if you do shallow studying, if you don't do deep learning, if you do shallow learning, quick memorization night before the time, there's not enough time for the subconscious mind to get to it. So you every time gonna have to think from scratch. But the moment the subconscious mind have stored what is stored, what you have told to store, what you have told it to store, then when your brain sees, it's going to recognize automatically, and I'm telling you, automatically, you're going to be able to think in a certain manner because you have trained your brain how to think. In other words, you have trained your subconscious mind how to think so that when it sees something, it's going to pick up and it will send forth the framework that you need to use. So that is why I always advocate for studying high quality, taking your time to study so that you develop these mechanisms. So yeah, just keep that in mind. And this is not me making this up. This is basically really based on neuroscience. Okay, I didn't know until I read about neuroscience. I'm very fascinated about it, so I read quite a bit on it. So that's when I kind of picked up. Okay, so just be aware of that. Okay, so how do we do this? Okay, so how do we think through? Remember, in order for this to be a taxable temporary difference, it must result in a taxable amount when you calculate taxable profit. So remember, what I did over here, I just assume a starting point, okay, just to make it more real. So I assume a starting point, profit before tax, and I make the exact same number for accounting profit and tax profit. Someone have a question? Oh no, okay. So for accounting profit and tax profit, I assume the exact same number, and I'm saying accounting profit and tax profit is exactly the same, except for that one temporary difference. Now I apply the definitions. Okay, now apply the definitions. So remember, in order for PPE to be recognized at 1,000 Rand, it is inherent in the definition of an asset that the asset will generate an income in future of 1,000 Rand. So in future, we're going to generate an income of 1,000 Rand. So that is what I'm putting over here, 1,000 Rand. That's the income we're going to generate. When we generate that income, Faz is going to tax us on that income. So they will also include the 1,000 Rand. But also, with an asset gets used over time. Remember, an asset is a glorified expense. It is an expense waiting to happen. So in the future, over the useful life of this asset, over the remaining useful life of this asset, we're going to depreciate the asset. So over the remaining useful life of the asset, we're going to depreciate 1,000 Rand. So the impact on the income statement from an accounting point of view is 0. So our profit is still 10,000 Rand. From SARS's point of view, they include the 1,000 Rand. However, in future, they will only deduct 800 Rand. So therefore, in future, they will actually have a taxable profit of 200 Rand. So as you can see, the accounting profit is 0. The tax profit is 200. So tax profit is more than accounting profit in future. Therefore, in future, we're paying more tax. And because we're paying more tax in future, it's a taxable temporary difference. When we have a taxable temporary difference, we have a deferred tax liability. So to just show you the 56, just to show you the 56 Rand, you can see over here, it will be 10 minus 10,200. And there you can see that times 28%. Okay, so there's the 56 Rand. So just take a note of that. So that is basically how you think about it. In future, accounting profit will be 0. In future, taxable profit will be 200. So therefore, in future, tax profit is more than accounting profit. So meaning we're going, we're paying more tax in future. When you pay more tax in future, that's a taxable temporary difference. When we have a taxable temporary difference, we have a deferred tax liability. So just to show that thinking over here. So just to show that thinking over here, we said it is, so in future, accounting profit is 0 or 10,000 Rand, depending how you look at it. In future, tax profit is 200 Rand or 10,200 Rand, depending. Therefore, in future, tax profit is more than accounting profit. Therefore, we have a taxable temporary difference. Therefore, we have a deferred tax liability. Remember, to recognize a deferred tax liability, you must have a taxable temporary difference. To recognize a deferred tax asset, you must have a deductible temporary difference. So let's go on to deductible temporary difference. So for a deductible temporary difference, we see the questions I wrote out for myself. Okay. Okay, so a company. So a company recognized a bonus accrual of 1,000 and for tax purposes, bonus is only deductible once paid. Okay. Bonus will be paid in the new financial year. Okay, there we go. Another example. Company rents out a premises to a customer, to a client. Okay, the client pays 2,000 Rand in the current year for the use of the premises in the new financial year. Okay, so there we go. So that's what we're going to do over here. So we can do the same type of thinking. We're going to do the same type of thinking. So we're going to do the same type of thinking. Okay. What do I have now? Okay, so we're recognizing a bonus accrual. So remember, we always look at it from the asset or liability point of view. The journal entry that the company would put through in the financial records would be debit bonus expense, profit or loss, credit bonus accrual, SFP. So the SFP is a bonus accrual, which is a liability. So we're going to have bonus accrual. What do I have there? 1,000 Rand. Remember, it's a liability. So for me, I put a liability in brackets. Remember, how you decide to do it is totally okay. You can have, I always just have my assets as positive and my liabilities. So for this part over here, I have my assets as positive and my liabilities as negative. By default, my asset will be negative over here, my liability will be positive. So how you do it, that doesn't matter. This is just the way I do it. Okay, so how you put your numbers in doesn't matter. You just, because it doesn't matter, you need to let the examiner know what you are doing. Okay, because you can put it either positive or negative, you need to tell the examiner how you are doing it. That is why I'm telling the examiner my debits are positive, my credits are negative. I tell the examiner over here, my debit is negative and my credit is positive. Debit asset, credit liability. So I have a liability, 1,000 Rand. So I'm making it negative because it is a liability. Okay. Now, what is the tax base? So remember, this is a normal liability. So we apply the normal definition for a liability. So the normal definition, carrying amount minus any amount that will be deductible for tax purposes. Now remember, the carrying amount is 1,000 Rand. We need to ask ourselves, what will be deductible for tax purposes in future? So here you can see a company recognized a bonus of 1,000 Rand. For tax purposes, the bonus is only deductible once paid. The company is only going to pay the bonus next year. So SARS is only going to grant the deduction next year. So how much is SARS going to grant as a deduction in future periods? The full 1,000 Rand. So therefore, over here, I must say 1,000, that's accounting carrying amount, minus what SARS will grant as a deduction in future periods, 1,000 Rand. Okay. And because it's a liability, I make it negative. Okay, so remember, how do I get negative? Most of us would know it is zero. Most of us would know it is zero, but we want to know why it is zero. So you apply the liability tax-based definition. So remember, the liability tax-based definition, accounting carrying amount, which is 1,000 Rand, minus any amount that will be deductible for tax purposes. What will be deductible for tax purposes? The full 1,000 Rand. So therefore, it is accounting carrying amount 1,000 minus what will be deductible in future, 1,000. So 1,000 minus 1,000 gives me 0. Okay. So now we need to ask ourselves, what is this? I already know it is an asset because my formula tells me when it's a debit, it is negative. So it is negative, so it's a debit. I know a debit represents an asset to me, and because it's an asset, it will be a deductible temporary difference. Okay, so this would be a deductible temporary difference. But I want to know why it is a deductible temporary difference. Okay, so this is a deductible temporary difference. Therefore, recognize a deferred tax asset. Okay, so my formula tells me that already, but I want to be able to convince myself why it is correct using the definition of a deductible temporary difference. Now remember, using the definition of a deductible temporary difference is as follows. A deductible temporary difference will result in a deductible amount in determining tax profit or loss in future periods when recovering an asset or when settling a liability. In our case, we're not recovering an asset, we are settling a liability. Okay. So how this look? So we use the same what I did earlier. We just start off with a base, which would be that. You don't need to have this line in. You can go straight, what you call it, but just to make it more real, or to get our head to, so our head can conceptualize it a bit better. We start off with a profit before tax. We are saying the profit before tax for accounting and tax profit is exactly the same, except for this one difference. Okay, except for this one difference. Okay. Now we're going to ask ourselves, okay, for this bonus in future, how much of that 1,000 Rand in future will be deducted for accounting purposes? So in future periods, how much of that 1,000 Rand will be deductible for accounting purposes? The answer is 0. Why? Because in the current financial year, accounting said debit bonus expense, credit bonus accrual. So in the current year, accounting took that deduction. In future periods, they're not going to take the deduction. In the current year, accounting did the following. In the current year, accounting did the following. Bonus expense, P&L, bonus accrual, SFP. 1,000, 1,000. In future periods, when accounting settle the amount. In future periods, when accounting settle this liability. So when they settle a liability decreases. A liability decreases on the debit side. So we say debit bonus accrual, SFP, 1,000 Rand. Because they are settling it, they are making a payment, we're going to say credit bank. SFP, 1,000 Rand. So in the current year, it hit the income statement. In future periods, it don't hit the income statement. So there will be no adjustment. In accounting profit, there won't be any bonus. There won't be any deduction. For tax purposes, the bonus get paid in the future period. SARS grants the deduction when a bonus is paid. So in future periods, SARS is going to grant a 1,000 Rand deduction. So as you can see, what is happening over here is that in future periods, accounting profit is 10,000 Rand. In future periods, tax profit is 9,000 Rand. So therefore, in future periods, there will be a 1,000 Rand temporary difference with a 280 Rand deferred tax implication. So by using the same thinking, in future accounting profit would be 0. In future, tax profit would be minus 1,000 Rand. Or in future, accounting profit will be 0 if you just look at that line, or if you look at it from this perspective, it will be 10,000. In future, tax profit will be minus 1,000, or if you look at it from that perspective, it will be 9,000. Therefore, in future, tax profit will be less than accounting profit. Because it is less than accounting profit, we will have a deductible temporary difference. Because we have a deductible temporary difference, we will have a deferred tax asset. Okay, so this is what you need to think about in order to conclude that we have a deferred tax asset. So basically, you will say in future periods, tax profit will be more than accounting profit. Why? Because in future periods, tax will grant a deduction, where accounting will not. So in future, our tax profit will be lower than accounting profit. Since tax profit is lower than accounting profit, we have a deductible temporary difference. And because we have a deductible temporary difference, we have a deferred tax asset. Okay, so that is basically the thinking on that. Now let's do on the income received in advance. Then I'll give you some, then you can ask me some questions before we wrap up on the last 2 points. So for the income received in advance, we had, what was the amounts here now? 2,000 Rand. Okay, so we received money of 2,000 Rand. Remember that the journal entry from an accounting perspective would have been debit, bank, credit, income received in advance. They can't credit rental income because they have not provided the service. So from an accounting perspective, we'd have 2,000 Rand. Because income received in advance is a liability, I make a liability negative based on what I have over here. Okay, you can have your own way of doing that. Now we must come to the tax base. In order to get to the tax base, we want to apply the definition of a tax base for income received in advance. So the definition for a tax base for income received in advance is carrying amount less any amount that will not be taxable for tax purposes. Okay, so we know the carrying amount is 2,000 Rand. We need to determine what will not be taxable for tax purposes in future. Now, when we received the 2,000 Rand in the current financial year, SARS would include that in gross income in the current financial year. Why? Because it meets the gross income definition. Part of the gross income definition speaks about receipts or accruals, right? So when you have a receipt or an accrual, it falls into gross income. We have a receipt, we have a cash receipt of 2,000 Rand, right? So therefore, it would be taxed in the current financial year. So next year, when accounting recognizes the revenue, because this year accounting said debit bank, credit income received in advance. Next year, when we provide the service, we're going to say debit income received in advance, credit revenue. So in our income, we will have a revenue of 2,000 Rand, right? But from a SARS perspective, what are they going to have? They're going to have nothing. So what will SARS not tax in future periods? SARS will not tax 2,000 Rand in future periods because they have taxed it in the current year. So therefore, the temporary difference is the tax base is 0. So therefore, the temporary difference is 2,000. As a result, the deferred tax is 560. Once again, it's a negative. So it is a debit. A debit is an asset. An asset would be a taxable temporary, a deductible temporary difference. But how can we prove that it is a deductible temporary difference? We can apply this exact thing over here. So what you can see, the way you think about it in isolation, okay? Don't think about it in total, think of it in isolation as if the income received in advance is the only transaction, okay? So, before tax, 10,000 Rand. We're just using that as a base. You don't have to use it as a base. You can ignore this line completely and just start over here, okay? So in future, accounting is going to include, 2,000 Rand. Because in future, accounting is going to recognize revenue, okay? So because in future, accounting is going to recognize revenue, debit income received in advance, credit revenue, accounting profit would have revenue of 2,000 Rand. Then, from a tax point of view, in future, tax is going to have nothing. Why? Tax is not going to tax anything in future periods because they've already taxed it in the current year. Remember, for admit the gross income definition in the current year. So as you can see, in future, accounting profit is 2,000 Rand or 12,000 Rand, depending how you look at it. In future, tax profit is 0 or 10,000 Rand, depending on how you look at it. Therefore, in future, tax profit is less than accounting profit. Therefore, we have a deductible temporary difference, and therefore we have a deferred tax asset. So it all comes to, based on the temporary difference, what impact does it have on taxable profit relative to accounting profit in future periods? So if tax profit is more than accounting profit in future periods, we have a taxable temporary difference. And if we have a taxable temporary difference, we have a deferred tax liability. And if in future tax profit is less than accounting profit, then we have a deductible temporary difference. And when we have a deductible temporary difference, we have a deferred tax asset. Remember, whenever you have an asset, it needs to meet the recognition criteria that the future economic benefits must be probable. So when you have a deferred tax asset, you will have to prove that that you can recognize that deferred tax asset. The only way you can recognize a deferred tax asset if you can prove in future periods you will benefit from the deferred tax asset. What is the benefit of a deferred tax asset? That in future, you can pay less taxes. How do you pay less taxes? You can reduce your taxable profit in the future. So the only way you can recognize a deferred tax asset is if you will have sufficient taxable profit in future periods. Okay, so that is that. Before we go on to the last two parts, is there any questions on your side? Yes, I'll give you a few seconds to ask me any questions if you have. If you don't have, we're going to end off with the last two parts.
Can you guys hear me?
Yes, I can hear you.
Okay, good evening. So my question is, if we were to render a service, and instead of getting income, we got a service in return. First of all, with the tax base, would we use the tax base? Which definition would we use? The income received in advance tax base or the general tax base for a liability?
So remember, the gross income definition talks about that. So remember the gross income, part of the gross income definition, when you, for gross income, I wanted to say now, it talks about receipt or accrual in cash or otherwise, right? So remember, cash, or I can't remember what's the term they use now, cash or or otherwise. So otherwise mean any non-cash. So you would have to recognize it from an open market value point of view, from an accounting point of view. If also receiving a service, there's a way of how you would recognize the amount from that aspect as well. So that is going to be the principles over here still will be exactly the same. The issue over here is at what amount. That is a separate issue over here. What amount? Because it all depends now. It's not the cash amount, so you'll need to use the other amount, the non-cash amount, and there will have to be ways of how we can be able to calculate that. That is not a deferred tax issue. You will still apply the normal principles regarding deferred tax. I hope that answers your question.
Yes, it does. Thank you so much.
Is there any other questions? If there's no other questions, we will. Thrice, do you have a question?
Hi, friends.
Hello.
Hi.
I can hear you.
Yes. Thank you, Faiz, for this lesson. It was quite an eye-opener. Well, I've got one follow-up question on assets. Let's say we've got a non-current asset, like for example, land, right? And then let's say it got revalued, because land, we're going to, usually land is revalued, right? So I want to ask, in such scenarios, how do we come up with our deferred tax? Because I would like to believe that we are going to enjoy the economic benefits through use and also through sale. So how do you go about calculating the deferred tax for such a non-current asset like land?
Yes, okay, so great question. That is a more complex example, so I'm not going to bring it through over here. We are going to cover that aspect when we do the question, so we'll have to split it up. So I'm going to talk through that really quickly when I go through the last two sections, but I'm not going to give it a detailed example I will cover that aspect when we do a more detailed example. Then I'll show you how to do it. So that's a very good question. You must be able to do it, but I'm going to touch on it. I do plan to touch on it when I cover the last two sections, which is going to be more easily explained over there. But the out and out complete calculations and how to set up your answer, I'm going to do that when we do the full-on question on Saturday. Okay. Any other questions? Any other questions? Okay, so we can move on. Okay, so I'm going to move on to the last two sections. Okay. Yes, so every Saturday will be a free class. Almost every Saturday will be a free class. This Saturday, the free class will be the question on deferred tax. Okay, so the last part I want to cover is recognition of a deferred tax liability, and then recognition of a deferred tax asset, and then recognition of deferred tax. Okay, so remember, the recognition of a deferred tax liability or the recognition of a deferred tax asset. So you recognize a deferred tax. So we recognize a deferred tax. What am I talking about now? So we recognize a deferred tax liability when we have a taxable temporary difference. Okay, so you recognize a we recognize a deferred tax liability. A deferred tax liability is recognized for all taxable temporary differences. Okay, so you recognize a deferred tax liability for all taxable temporary differences. Okay, just so you can know, I'm just going to put in brackets. There are some exceptions. I'm not going to go through the exceptions. Okay, a deferred tax asset. A deferred tax asset is recognized for all deductible temporary differences. So a deferred tax asset is recognized for all deductible temporary differences that is probable. Okay, I'm not going to write the whole thing, but that is probable. And once again, there are some exceptions. So remember, this is very important. I'll just make this big as well. That is probable. Okay. So what is probable? That the future economic benefits are probable. What are the future economic benefits for a deferred tax asset? That in future you have sufficient taxable profit against which the deferred tax asset can be utilized against. Okay, so if you think about tax, you can have a tax loss, right? Or an assessed loss. So if you think about taxation, you have this assessed loss. When can you use the assessed loss? You can only use the assessed loss in future periods if you have sufficient taxable income. Okay, so if I don't know if you remember the format of calculating taxable income. Well, when you calculate taxable income, you will have taxable income before assessed loss. Then you will have a line item called taxable assessed loss from prior periods. Then you will have a line item called taxable income after assessed loss. Now you can only utilize an assessed loss. So SARS, if you read the Income Tax Act, SARS will only allow you to use the assessed loss in future periods if you have sufficient taxable income. So therefore, understanding that fact, you can only recognize a deferred tax asset if it is probable that you will have sufficient taxable income in future periods. Okay, so that is basically it over there. So that's the difference between this one and that one. This one doesn't have probability. That one has a probability. There are some differences over here. How you can recognize a deferred tax asset, and I'll talk through that when we do a full-on question next week. But the general rule, this is the general rule. Like I said, there are some exceptions. Okay. Now we go to the recognition of deferred tax. Okay, so remember, this part talks to the statement of financial position part. Okay, this one is talking to the other part. Now, this refers to the balance, and the balance, this refers to the movement in deferred tax. So the deferred tax asset, deferred tax liability is a balance. This deferred tax is a movement in deferred tax, which will either hit the income statement or it will hit the statement of changes in equity. Okay. Now, what's very important to take note? Okay, so what is very important to take note is the following. Yes, I'll send a link for the Saturday. So what you must understand, the general rule when it comes to deferred tax, so this applies to current tax as well, but I'm talking from a deferred tax point of view, okay? So the accounting treatment, okay, so the accounting for deferred tax, and this applies to current tax as well. I'm going to explain this now, is consistent with the accounting for the underlying transaction itself. Okay, so remember, tax only results from underlying transaction. Okay, so tax only results from an underlying transaction. So, so tax only results from an underlying transaction. So this over here is saying the accounting for deferred tax effects, and this applies to current tax effects as well, is consistent with the accounting for the underlying transaction itself. It means, what does this mean? So what does this mean? It implies that if the underlying transaction goes through profit or loss, then the deferred tax will also go through profit or loss. And the same thing would apply over here. If it goes through OCI, the deferred tax will also go through OCI. If it goes directly through equity, if it goes directly through the statement of changes in equity, then deferred tax also goes directly through the statement of changes in equity. Now, this is an extremely, extremely, extremely important concept. Even if your numbers are right, but you put it in the wrong place, they're not just going to mark you wrong, they're going to subtract marks as well, okay? So even if your numbers are right, so even if you calculated the correct deferred tax, but you're taking it to the wrong place, you're not only going to get it wrong, you're also going to be penalized. They're going to subtract marks because it's a fundamental principle. So for example, if a fair value gain goes through profit or loss, the deferred tax must also go through profit or loss. If a revaluation gain goes through OCI, then the deferred tax must also go through OCI. If the underlying transaction goes directly through the statement of changes in equity, typically through retained earnings, then the deferred tax must also go directly through the statement of changes in equity. Very, very important. Remember, when we put a journal entry, we always say SFP, we always say equity, or some of you would say SCE. We always say P&L, or we always say OCI. Remember, if I can use the term loosely, I'm going to use this very loosely. When we look at from a balance sheet point of view, it will be SFP. Okay, it will be SFP. An income statement point of view, it would be P&L or OCI. That is why when something hits the income statement, you need to make it really clear whether it is P&L or whether it is OCI. Without showing that, you don't get any marks. Without showing that, you won't get any marks. Okay, so just be aware of that. So that is why you have to show P&L or OCI. And if something hit the statement of changes in equity, then we say it goes directly through equity. So for example, a transaction that hits equity directly, it is dividend declared or dividend paid. The reason why dividend declared or dividend paid goes directly through equity, it is because it can't go through the income statement. Why can't it go through the income statement? That's the big question. Remember, what goes through an income statement is only income and expenses, gains and losses. That is a transaction other than a transaction with the owner. So if you read, I think it's a conceptual framework. So in the conceptual framework, they give the definition of an asset, of a liability, of equity, of income, and of an expense. If you read the definition of an income and expense very clearly, you will come to learn that an income and expense is an income and expense that is a transaction other than a transaction with the owner. So something hitting the income statement can only be an income and expense. That means it can only be a transaction that is a transaction other than a transaction with the owner. So when you make sales, that is a transaction with customers. It is not a transaction with the owner. When you have cost of sales, that is a transaction with the customer, a normal business transaction, and it is not a transaction with the owner. When you depreciate and all of those type of stuff, that is a normal business transaction for running the business. It is not a transaction with the owner. But when you declare a dividend is a transaction with the owner. Why? Someone can only get a dividend if they have a share. You can only have a share if you are owner. Okay, so remember, what makes dividends paid or declared a transaction with the owner is the fact that a dividend declared is only declared to a person that owns a share, and a person that owns a share is an owner in the business. So any transaction that is a transaction with the owner goes directly through equity. So that is why it's important that the movement of deferred tax is either going to go through the income statement or through the statement of changes in equity. If it's the income statement, you need to clearly show whether it is P&L or OCI. If it's statement of changes in equity, you either say SCE or you say equity. That's very, very important. The principle over here, accounting for deferred tax or current tax is accounting for a deferred tax effects of a transaction is consistent with the accounting for the underlying transaction itself. Okay, so that is extremely, extremely, extremely important. Okay, so for example, on that land example that the person spoke about, land can only be recovered through sale. Okay, so land can only be recovered through sale. Remember, an asset can be recovered in two ways, either through use or through sale. When you recover an asset through sale, it will generally attract the CGT rate. Now remember, when land is revalued, the revaluation on land goes through OCI. How do we know it goes through OCI? Because IAS 16, property, plant, and equipment, that standard tells you that the revaluation is recognized through OCI. So the deferred tax would go through OCI. Now the deferred tax would be at the 80% rate, not the 100% rate. Why we use the 80% rate? Because land is recovered through sale, and anything that is recovered through sale that is a capital asset will attract the CGT rate. But we will discuss that in detail on the Saturday class. So that's all that I wanted to cover from a theory point of view. This is not everything in IAS 12. This is not even everything of deferred tax in IAS 12. But these are the more important aspects regarding IAS 12 deferred tax. So that's all from my side. I hope you found the 2 days beneficial. On Saturday, we'll from 11 till 12, latest 11 till 12:30, we will do an exam question or a test question. I will send out a link via email on Thursday with the question. Okay, so if you have any questions, please let me know. If you before you leave, I just want to share a form with you so I can get your details, so I can share all the like the classes with you. I just want to get it quickly. I'm going to share a link quickly with you. I'm going to use the details on this form I'm going to share now to contact people that, so here's the form. I'm going to use the details on this form to contact people for the Saturday class, as well as for the future Saturday classes, okay? So if you want to be notified, you can complete that form. It'll take you less than 5 minutes. Just your name, email address, and so forth. So then I can email you and WhatsApp you the details for Saturday as well as for future Saturday classes. So hopefully the class was really useful and beneficial, and that you can now tackle a basic deferred tax question with deeper understanding and actually applying IAS 12 and not just memorization without understanding. And remember, you have to memorize, but you want to memorize principle so that you can use the principles to apply it to any scenario going forward. Okay. Thank you very much, guys. I'll give you a few more minutes to ask any questions. If you have filled in the form, and if you want to, you don't have to. If you want to fill in the form, please fill in the form. And otherwise, you guys are good to go.
Hi.
Hello.
Do we have to pay for Saturday class?
No, it's free.
Okay. Will you send a link, please?
I will send a link on Thursday to the class for Saturday, but you must complete the form so I have your details. If you're not on the form, your details are on the form, I won't be able to share the link with you, but I'm going to only contact people on the people's deals on the form.
Oh, okay. All right. Thank you. Do you perhaps know which question
I will share the question on
should
Thursday.
we prepare for Saturday?
Yeah, so I'm going to share it on Thursday so you can prepare for Saturday. I'm still trying to find a nice. I have a few questions already, but I want to see a question that covers most of the important concepts, but it's also nice and challenging.
Thank you so much, sir.
Evening, just before you leave, can I ask if you can please share the spreadsheet with us, the one that you are
Yes,
actually working on through the class?
When I share the recordings, I will share the spreadsheet as well.
Oh, okay. Can I just check? Is it going to be via email or WhatsApp?
So I generally do it via both. So it will be via email to those on the list and via WhatsApp to those who are in the group. So I'm not going to WhatsApp individual people. I just WhatsApp people in the anyone's group, and then I email whoever's on the email list, and they will get the recordings as well as the spreadsheet. Here's the link to the list again. The email list. When I say the list, the email list is the people that filled in the form. They will be on my email list that I can email. Sanka, do you have a question to ask?
Sorry, how are you?
I'm good. Yourself?
I'm good, man. Okay, so I'm at work currently, so I'm unable to join the class. Can I have like the recording of the two classes for yesterday and today?
Yes, so I will upgrade to email it out to everybody by Friday.
By Friday.
Yeah. If not tomorrow. What is tomorrow? Wednesday? No, Thursday for the latest.
Thursday. Wait, so I will receive it on my email now.
You will receive on your email. If you completed the form I shared in the group now in the chat, then you would get it.
Okay, I'll only be able to complete it after work.
That's fine. That's fine. You don't have to complete the form right now. The form will be open till Saturday. Yeah, okay, so the form is for everything. Okay, so whoever's on that list, you put your details over there, you will get three things. Okay, you're gonna get an email with weekly summaries. Okay, so every week I'll share a high-level summary of so I run courses, paid courses. So what I'm going to do, I'm going to share freely a summary of the important learnings that the students in my class did learn or supposed to have learned. Okay, so every week I'm going to email that. But that weekly email is only going to start from March. Okay, and then you're going to receive emails for the free Saturday classes. So every Saturday or almost every Saturday, I'm going to have free classes for 1 hour to 1.5 hours that will be shared over there. And the Saturday class will always start at 11 o'clock, 11 till 12:30, 11 till 12, 12:30 latest. And then also what we shared is I will, like any recordings of the free classes. So any recordings of the free classes will also be shared over there. Okay.
Okay, no problem, sir. Thank you.
So if it's on that list, will get access to it, because I would only be able to email the people on that list, so I'll have their details. So that is the purpose of it. Okay.
Okay, no problem.
Okay, thank you.
Okay.
Can I just ask also that you can share how we can actually join and also be on the program, the paid program?
Yes,
the information there, the registration form. Can you also share that?
I will share that also in an email on Thursday. Okay, so on Thursday you'll get everything. Okay.
Thank you.
Okay.
Thank you, Faiz.
Pleasure.
Hey,
Okay. Bye.
so how can
Yes.
we join the WhatsApp group?
I'm gonna give you the link now. I'll just wait here. I'll give you the link.
Okay, thank you.
Okay, so that's the link to join the WhatsApp group. But obviously you need it on WhatsApp. Okay. You just copy that link and paste it in WhatsApp and then join. Okay. Okay, guys, good to go. I'll see you guys on Saturday. You should get an email from me on Thursday with the recording and Excel spreadsheet with the link to the free class on Saturday. Remember, every Saturday or almost every Saturday we'll have a free class, and then also some information regarding our courses. Okay. So thank you very much, guys. And also for this Saturday will be the deferred tax class, but future Saturdays, you can let me know which topic you'd like to cover. Okay. And then I'll select based on the most common ones. Okay. Thank you very much, guys. Have a great evening and have a wonderful week going forward.
Thank you. Thank you. Thank you.
Bye-bye.